Welcome back to the course Introduction to Commercial Banking and FinTech. In this particular course, we are discussing the FinTech portion. We started and we had a background about different theories and explanations with regard to the FinTech, and it also gave us a lot of idea about how we can understand the FinTech ecosystem, how it works, what are the theories. So, the most prominent concept came out was the cost effectiveness, that FinTech helps in cutting down cost as compared to conventional banking that we often see. And in most cases, we found that the ease of doing business is much easier in FinTech as compared to conventional banking. And with that, there are already, I would say, discussions going on that how to regulate that, because we saw in case of US that in Silicon Valley, when FinTech started with the mixture of digital database and the usage of large database into the business and finance activities, there were issues that certain startups were not following the rules, and as a result, the FinTech as an overall, I would say, system did not evolve in a better way. We also saw a bank collapse in case of US, Silicon Valley Bank, we discussed also. So, with FinTech, there has been issue of how to regulate this particular sector when almost everything is on the digital platform. So, there is nothing called physical as such. So, when everything is on digital platform, then how we can regulate. For the central bank also, it has become a major challenge. In case of India, we saw the Paytm case, that how Paytm was targeted by the central bank, and finally the Paytm had to go through certain changes in its business activity, and as a result we found that the banking sector also felt a bit of the impact of the Paytm saga. So, in India, for example, the banking sector is going to touch upon certain areas which are conventionally part of the FinTech. It is supposed to be, but the banks are coming up because they find that the FinTech startups are not that great. So, overall at the global level also, there has been a lot of discussion on how to regulate the FinTech ecosystem. So, with that regard, I have planned one or two lectures on that, and we will continue also in further lecture. So, in lecture 55, we are going to discuss about the architecture of the FinTech regulation, that how do we see, what are the I would say pros and cons, what are the methods through which we try to regulate, and especially in the global setup, UK is coming out to be one of the leading countries which has the proper FinTech regulations. So, we will also touch upon those dimensions. There are angles with regard to the expansion, different types of the emergence of the FinTech startups. So, we will touch upon also those dimensions, that how FinTech regulations are trying to capture and trying to regulate those dimensions. So, let us start. We are going to see in two ways that how we can go about. So, I have designed this particular lecture in a such a way that you will have the feel of both the FinTech as such as in the ecosystem, and also how the different terminologies are being evolved over a period of time, and how FinTech is contributing to the field of finance and commercial banking. So, as we have discussed so far, that FinTech improves efficiency. So, efficiency in the sense that the cost advantage that we saw, that how FinTech is getting into the cost advantage, how it enhances the efficiency of the commercial banking, right. So, this dimension we saw, right, and we also saw about the models that we were discussing about the usage of the big data, right, digital infrastructure. So, India stack we discussed already. So, an inclusion is basically touching upon the FinTech and financial inclusion. So, in case of conventional setup, we were talking about the utilization or facilitation of services to the to every section of the society. In case of fintech, it has become much easier, especially when we saw the, for example, you have UPI, right? So QR scan code, it doesn't matter who is, you have the full advantage of accessing those services. So it implies inclusion implies here, but the major challenge with this is the volume of transaction. Second is because volume is larger, so then here you have the cyber security issue. So cyber security becomes an issue here, that how we can amplify the and how we can regulate. So the regulation comes first with the efficiency. Second is the inclusion, which means that efficiency in the sense that in India we see that when we transact and when we do transaction of a certain limit, we are supposed to have the OTP, right? But on in the name of efficiency, certain fintech startups may also say that they may not want to have the OTP, I would say, verification. Then in that case it becomes an issue. So efficiency, of course, we require, but it should not be at the cost of the safety. Inclusion is, of course, a better angle, that we are expanding the fintech horizon horizontally in a very efficient manner, but the volume and transaction, it is again creating a vulnerability of cyber risk. So this is also, and the risk as such, it also creates a big impact. So this is how we measure. So in order to consider all these factors in mind, we have something called consumer protection, which is like we saw in 2008 in US, also in India, that when you interact with any financial agent, they try to oversell a particular product, or sometime they also go for over promising or under promising. So those cases are also being noticed. So mis-selling is like you are not eligible for certain product, but incentives are attached by the banks for selling. So they are selling to individuals who are not also entitled or who are not eligible. So mis-selling is one idea. Hidden fees, like for example, they have not revealed that if you are utilizing this particular service, then you are supposed to pay a certain amount of fee. So hidden fee is one. Coercive recovery, this has been seen with regard to the majority of the loan recovery that we see in India. It is sometimes it leads to a lot of violence, and the matter has reached till court for the settlement. So mostly when we see a loan default, so coercive recovery. In case of India, during COVID period, we saw that the fintech app-based lending came in limelight because they were targeting the vulnerable section in the society. So for example, for micro loaning, if you are borrowing from app, the micro loaning, if they are not able to pay back on time, so then they were harassed with the social dimension, and also sometime the gender dimension was also involved. So sometime the women were forced to compromise on modesty, and other cases were there. So which means that the coercive recovery is one of the important angles. So when we see the expansion of fintech, this becomes one of the important area. Then here we have the opaque pricing, which means that in the beginning you did not mention about a particular rate, but suddenly you are increasing the rate, and it becomes extra burden on the individual. So consumer protection, it becomes the major angle. Operational and cyber, as I said, that we have the inclusion, and inclusion leading to more volume in the transaction, and this could also be outages, like app is not working. Data breaches, like you have volume of data and you are not able to handle, and this vulnerability is creating a lot of impact on the security, and also on the angle of the trust and the inclusiveness. So this is basically deals with the credibility. So credibility is mostly lower with the private entity, so credibility becomes an issue. Identity theft, when you are going for eKYC, for example, a lot of time we see that the app based fintech startups, for example, if you are with any kind of Paytm or any kind of entity, you are supposed to have the eKYC, and eKYC helps in getting things done in a very efficient manner, but at the same time you are providing a lot of data in a digital form. So that could be one case, and ultimately it leads to the case of fraud. So, this is also one angle. Market integrity, which means that asset management liability is how we have the mostly with regard to the businesses. So, how are you going to see with regard to the mostly you can think about the transactions and also in terms of credit facility. So, how you are going to see that. Then here the accounts that you have, and also the money laundering or any kind of suspicious transfer that you see. So, that could be one of the areas. So, this is overall linking again with, I would say, credibility. So, central bank credibility is one area that we often discuss. After fintech, it has become one area also to look at. So, stability in the sense that you have a lot of market expansion, there is a whole lot of interconnectedness with banks, NBFCs, and also you have smaller entities which could be like AA account aggregators, which also could be like a RegTech kind of setup, different regulators, right. So, all these things are being part of. So, overall what it comes out that trust becomes an issue, and it also leads to overall a systemic risk. So, this is linked again with this risk. So, we often say we are in the 55th lecture now. So, now we are aware about, so it is called a systemic risk. Systemic risk is also one angle that we often touch upon. Now, when it comes for the regulator, what should be the objective for the regulator? So, regulators have normally 4 objectives in mind. One is that they avoid runs that we have discussed, that diamond and the big model. So, how bank run happens, we have already discussed this part. So, let us not get into. So, avoid runs. Runs means bank runs. So, fintech, if they are operating, then how they are trying to cope up, and there should not be any trust deficit, otherwise there will be heavy withdrawals, and as a result bank will have to go for liquidation. Now, here you have the case that we often see is with regard to the, for example, we saw with the SVB bank, Silicon Valley Bank, then how it failed because a lot of people had the internet banking access, and they transferred the money immediately when they found that the bank is going to have the extraordinary or unprecedented risk in credit rationing. So, it also became an important issue. Then comes the contagion. Contagion is one area that we often touch upon when it comes to have the interconnectedness. So, it is coming back to previous slide where we discussed the interconnectedness. Contagion basically implies that during when we have a shock occurring in the economy. For example, we saw yesterday the HDFC Bank saga, that how it created. So, with this event occurring, how different banks are seeing increase in correlations. For example, due to HDFC issue, how other banks are seeing higher instability with regard to their transactions and asset side and also on the liability side. So, it becomes an issue, which means that they are receiving less deposits, higher loan default. So, those kind of cases. Excessive leverage we have already discussed with different angles. Protection, all these things, transparency. Then here we have the grievance overall redressal system. So, in India we developed long back something called Indian Financial Code, IFC we call it. It was recommended by Shri Krishna Committee. So, Indian Financial Code, we normally call it as IFC. So, though it has been partially implemented back in 2016-17, it came, and IFC had all these angles that if you are buying a credit card from fintech, and if you are seeing some unfair transaction and you don't know how to where to put up the case, you may be contacting the company, but if company doesn't respond on time, then you are going to lose money. Where you should reach out, what are the regulations? So, it recommended that the regulatory body grievance in terms of redressal system, it should be at the district level also, and it should be at the town level, so that people can go and whatever they have queries or grievance, they can register. So, this is one area, and once we address this, then it leads to fair conduct. So, this we know already. integrity becomes an issue. So, here we have the anti-money laundering compliance, reporting and others, and innovations of course, we are going to talk about. So, FinTech is an innovation that we all know, but it has to be well suited with stability and the consumer protection. So, this is what we touch upon. In India, there are different levels of there are different regulatory layers. For example, RBI regulates the banking, SEBI regulates the stock market, PFRDA regulates the pension funds. So, pension fund a regulatory development authority. So, PFRDA we say. Insurance is regulated by IRDA. So, which means that in India nothing is under one umbrella. So, if we have to launch, for example, if Paytm wants to launch a product, then it can only facilitate transaction with UPI. So, which means that it is supposed to comply with the RBI. But at the same time, if Paytm wants to start the trading business, for example, they want to get into, we have a very famous startup called Zerodha. So, Zerodha gives the access to in terms of trading. So, they have the different demat options available. Now, if we see also that if Paytm wants to launch that kind of service, then they will have to go for SEBI approvals. Similarly, if they want to sell also insurance product, they want to accept premium and they also want to keep register of their whole account, then they will have to take with the IRDA. So, in India, the umbrella governance structure, it also creates trouble for the different entities, but from the consumer protection side, it is always better that you have specialized institutions to monitor activities in those. So, FinTech is regulated mainly by activity, what you do, and not by level. So, this is one of the major critical difference that we have to notice. So, I think this I touched upon already. So, IBR, SEBI, and now in India we are having the international financial services also, and with that we are in Gujarat we have a GIFT City. So, GIFT City is bringing up the technological innovations and also the collaborations, arbitrations at the international level, which means that in the GIFT City, whatever rules that we have in India by RBI and SEBI, it will not be applicable. It will be applicable only at the international level activities, and this is where it becomes an important framework. Let us get into the core of it. So, this was the background that we covered. So, I hope you have liked, and if you have any issue, you can always write to us. So, RBI digital lending is the core rule. So, what is the core rule? So, one is the lending framework. So, which means that here we have the regulated entities. So, RBI has the designated regulated entities, and these entities are empowered to have the overseeing of different activities. So, how they are going by. So, one is the fund flows discipline, which means that whatever the money that they have, it has to go to the direct borrower's account after due diligence, and then it should not go to anyone's account. Then here we have the repayment discipline, that it has to be maintained by the RE's account, and here we also get into the key fact statement. So, this is very important. So, key fact statement is like getting back to Basel II norms, where we calculated the probability default. Key fact statement becomes important. So, annual percentage rate, fees, how much is the tenure, cooling off period, grievance redressal. So, all these things part of, and each and every RE is supposed to have this record. Accountability, RE is also responsible for conduct of lending, which means that if RBI is going to give the license of REs to any of the FinTech startups, they are supposed to comply with these rules. If they are sanctioning any loan, it has to be transferred or credited into the borrower's account. Then the repayment, so they have to maintain a proper record, and then we also find that they have to also go for proper disclosure, which means that anyone, if RBI wants, they can see, which means that whatever rate they are charging, whom they are charging, what is the amount, what has been the tenure, what has been the cooling off period, and is there any kind of conflict of interest between borrower and lender. So, those also have to be revealed, which means that FinTech, basically the idea is that RE should have the fee opacity addressed, mis-selling and shadow lending. So, this is where, so when we got independence long back 47, we had majority of the money lenders based borrowing and lending, it was almost 70% share, Then we introduced the different banking system and it reduced to almost 20 or 15%. But now fintech coming in, it has become again a major challenge. So we are trying to address those old issues that we have addressed in the past. Let's have the example one. I think this example will help you, I would say, crystallize your understanding about the functioning of the fintech regulation, especially the REs. So here we have, suppose a small ticket credit, which means that suppose the amount is 10,000 and a borrower wants it for 30 days, interest is suppose 300. So processing plus service fees is equal to 1700 that here we have. So total due is how much? Total due is going to be 1700 plus 3, so 12,000 that here we have. So borrower has to pay 12,000 in 30 days. So which means that in a very implied way that how much is the cost. So it is effectively coming out to be 20% because 20% of 10,000 is 2,000. So this particular customer is incurring the higher cost, which means that it has to be maintained with the KFS that how they are dealing with. So which means that key fact statement must have these details and they have to reveal. So APR disclosure that how much they are charging the interest, transparent fee structure that how much they are charging for processing and service, and cooling off period. So this also becomes an important dimension in this regard. Then there are two important dimensions that I want to highlight here. I think we have already done these things when we're discussing the Basel II. So here we have the default loss guarantee and then you have the first loss default guarantee. What is the meaning? It is some kind of the contractual risk sharing arrangement where a lending service provider, so LSP or partner entities, agrees to absorb a portion of credit losses for a regulator. So LSP is basically created to absorb the shocks of the REs and how it works. So RE, which is like bank or NBFC, originates and funds the loan. LSP sources and underwrites borrowers, and it also gives the first loss guarantee up to a cap percentage. So I have already given one example here. I think it will come. So this is like, suppose your total exposure is 100 crore. So RE has the exposure of 100 crore. So here is the role of LSP. Probability default that we calculated based on KYC, it is coming out to be 8%. Loss given default is 50%. So expected loss without DLG is how much? It is going to be rupees 4 crore, which means that we are multiplying 0.08 with 0.50 into 100. So it is coming out to be 4 crore. And if fintech is providing 5% of the portfolio, which means the DLG cover is going to be around 5 crore and its expected loss is 4 crore, it means that it is well covered, which means that actual expected loss is rupees 4 crore, which is less than the DLG cover. So this gives the whole advantage, which means that RBI under its regulatory entity, what it does is that it gives the LSP the power to absorb the shocks done. So this is what I was saying, that LSP provides the first loss guarantee and it is capped, suppose it is at 5%, so then it will be. But the challenge here, since we have done the commercial banking also, but the challenge here is that this LSP, it is a fintech entity. So what is the capital structure? So will it have the CET1 that we did, common tier 1 capital, common equity tier 1 capital, additional tier 1 capital, or it will be just a funding amount that the fintech is having. So this becomes the important challenge here, that how we are going to deal with. So first is the formal contract arrangement. So why we want between RE and LSP. Second is potential governance and reporting requirements. So this is what here we have. Third is the enterprise risk shifting from RE to fintech. So this also provide, and it also gives the bank fintech partnership. So all these angles are attached. Now comes the loan aggregators, right? So what is the meaning of it? So loan aggregators, like most of these startups are having the fintech platform, right? And these digital platforms are also providing the good amount of lending and borrowing services. So which means that the Loan aggregators, if you are looking at the organic side of the loan aggregators, a lot of time the advertisement, the kind of appearance, it matters, and because of that there will be a lot of information distortion. So in order to do that, the regulatory agency looks at how is the marketing structure of all these aggregators, what has been the impact of those, is there any negative impact, has there been any kind of hawkish kind of strategy or very aggressive strategy. So that we often discuss and deal here. So bias ranking to offers, higher commission lenders shown first, disguised promotions, percentage are recommended. So all these angles are being looked by the regulatory entity, and this is where it becomes important. For example, I will be giving you one example and then we'll stop this session. So loan aggregators, for example, you have two loan offers displayed by the so if you want to borrow from the loan aggregator, so you have two options. Loan A, it is having the APR of 12%, tenure is 12 month, right. Second is the APR is having 18% and tenure is 12 months, so it has the higher cost. But if the platform ranks loan B higher due to higher commission, then if the borrower selects B, if it is thinking that it is better, then but you will feel that the based on the recommendation, if the borrower goes by this, that we often see with majority of the digital platform, that they are inclined towards one particular product or service because they have the higher commission, but ultimately the borrower is going to pay 6,000 extra just because of these displays that they have. So information asymmetry plays important role. We also see that the same amount of money is being allocated at different rate. So misallocation of credit becomes a case here, and this is where it becomes. So with this background, I hope, let me give you the summary of what we covered. So we covered the objectives, that why fintech regulators are required, why there should be different regulatory norms for the fintech, especially with regard to the efficiency and inclusion, and also we also touched upon the dimensions related to how the businesses have to be conducted. So we saw that here we have the regulated entities assigned by the RBI, and on top of it you have the supervisory norms given by the LSP, and then we see that whatever the amount of exposure that REs has, it is being somewhat covered by the fintech. So this is also one regulatory dimension. But overall, it is more on the trust and credibility that the regulators always have in mind about the fintech. So going ahead, we'll have further dimensions added, and I hope with these dimensions we're getting new understanding. There is no as such textbook or material on this because these dimensions are evolving. So I have gathered through different sources, and maybe when I finish this particular part, then I will give you the comprehensive list of sources to refer for yourself and for your understanding. So with this, I am stopping it here. Thank you so much. I really appreciate your attention.